if you allow too much discretion in how you value companies, people will find ways of justifying buying expensive companies, and they'll find ways of avoiding companies with problems. So we think people have justified owning property trusts and infrastructure stocks and even some healthcare stocks by applying consistently lower discount rates, rather than actually having strong growth in free cash flows that justifies those share prices. So we think the market has over-extrapolated, low interest rates in some stocks rather than focus on the actual underlying cash flows. So we don't see value in those, I guess you call them those bond proxy or safe sectors. The other one is commodity prices that are generating good cash flows right now, but we don't believe they're sustainable. As I said, our focus is very much on long-term sustainable cash flow, not today's cash flow. The miners are still enjoying commodity prices that, to be truthful, are higher than we probably expected they would be right now, but they've also cut back on capital expenses and operating expenses, which we think is not sustainable, and they will need to reinvest again. So the cash flows will come down, and they're not as cheap as they look based on current cash flows. You do have to be patient to be a value investor. We do take 3 to 5 year views at least on our investments. Iron ore, we look at two aspects. There's the demand side. We don't believe it's sustainable for the current rate of demand growth of China for our iron ore to continue at these rates as the country shifts from fixed investment to consumer-related GDP, as the recycling market develops in China, as it has everywhere else. We'll see the steel intensity of their growth reduce. And you've got the supply side with more iron ore being produced at lower cost by the large producers that we know about. So you've got rising supply at a low cost, and we don't believe demand can be sustained at these levels, and those two will meet and determine a lower iron ore price. So we do still stick with that view. And when you take a very long-term view, what you see is the actual cost of the long-term average of iron ore is probably around $20, and it's actually been declining through time when you adjust for inflation, and that's because I guess the miners are becoming more technologically advanced and reducing their cost of production. It is, in the end of the day, a commodity. You can't differentiate it. You can't charge a brand premium. So ultimately, it will come back to the cost of production, which we believe is declining through time.